There is a crushing weight placed on young adults today. Society insists that the second you get a decent job, you need to buy a starter home immediately, or you are just throwing your money away. However, in the current housing market, a web of hidden transaction fees and massive closing costs can quietly erode the very wealth that homeowners believe they are building. We've all been handed the exact same financial script. From your parents to your friends and the internet, they all tell you that renting is just paying someone else's mortgage. But today, the underlying numbers have shifted. If you only plan to live in a house for 5 to 7 years, signing that mortgage is mathematically a highly flawed decision. So let's look at the actual math. First, we have to look at what a starter home actually costs right now. Across dozens of U.S. markets, the absolute baseline entry price is exactly $500,000. In major markets, $500,000 secures a 1,200 square foot box with beige carpet, laminate countertops from the early 2000s, and a yard roughly the size of a beach towel. This chart shows the reality of that squeeze. Since 1990, median home prices have exploded by roughly 400%, while median household income has only crept up about 180%. The math simply doesn't work. Yet buyers are stretching their budgets to the breaking point, taking on extreme financial leverage for inadequate properties, purely out of a desperate need to build equity. To understand why that equity never materializes, you have to look at the reality of the mortgage amortization schedule, the specific timeline of how your loan is paid off. Imagine taking out a $500,000 loan at current 6 to 7% interest rates. This 30-year mortgage chart shows your $3,000 payment almost entirely funding interest. Banks front-load profits, keeping principal paydown flat early on. If you stay the typical 5 to 7 years, you barely dent the actual debt. You aren't building wealth during this initial holding period. You are essentially just renting the capital from the bank and paying a massive premium to do it. But the interest rate is only the first part of the trap. The second layer is the relentless, ongoing, invisible carrying costs of property ownership. The standard rule of real estate is to budget 1% of your home's total value every single year just for maintenance. That is an extra $5,000 annually just to prevent the physical decay of an aging starter home. And those expenses never happen on a convenient schedule. When the air conditioning dies in the middle of a July heat wave, that is $3,500 to $5,000 you suddenly have to finance out of pocket. Add to that the compounding, inescapable monthly burdens. You are paying soaring local property taxes and homeowners insurance premiums that rise every single year. And if you couldn't scrape together a massive 20% down payment, you are hit with private mortgage insurance. It operates like a PMI poverty tax, costing you hundreds of dollars every month, serving no purpose other than to protect the lender in case you default. Together, these expenses act as a slow, continuous bleed, quietly draining your bank account dry for the entire time you occupy the home. Let's fast forward 5 years. You've outgrown the cramped space, your lifestyle has changed, and you decide it's finally time to sell and move into a forever home. This chart illustrates exactly where the trap snaps shut. When you sell, real estate agent commissions are calculated on the total sale price of the home, instantly consuming a massive percentage of your perceived value. Because your early mortgage payments mostly went toward interest instead of the principal, these closing costs and transaction fees completely neutralize whatever tiny sliver of equity you managed to build. You spent half a decade stressing over broken air conditioners, property tax hikes, and incredibly tight budgets, only to walk away from the closing table with basically zero profit. And nobody facilitating the transaction has an incentive to warn you about this wealth destruction. The system is designed to get you into the house and collect the fees, not to ensure you are actually building a financial future. Society loves to tell you that renting is throwing money away, but tying up your cash, destroying your wealth in hidden fees, paying extreme interest, and funding forced carrying costs is also throwing money away. It just requires a lot more steps. True financial wealth requires margin in your budget. If you only plan to stay in a location for 5 to 7 years, renting and investing the difference in index funds is mathematically superior to taking on the immense friction of buying temporary walls.